Welcome tycoons. There is no doubt that we are sitting in unpredictable times. Today, we will be taking a look at where to invest $1,000 in recession. Now before we get into the video, if you are new, make sure to subscribe to the channel, hit that like button, and leave a comment below, saying, "I subscribed." And we will do our best to personally reply to your comments. Disclaimer: it's important to note that we are not financial advisors and you should do your own research when picking stocks to invest in. These are just some of our viewpoints. By no means would we recommend watching one YouTube video and then immediately buying that stock. This video was made for educational and entertainment purposes only. Consult your financial advisor. Here in Project Billionaire we inspire and give value to future great magnates. We are living in uncertain times when it comes to the financial markets. I think we can all agree on that. With the virus, the global economic shutdown, and other unforeseen events, where should we be making investments at this time? Therefore, I'm going to assume that we have $1,000 to work with and that in this video, we'll be building up a portfolio that is ready for these uncertain times with the help of this $1,000. I've got 5 key investment types that I want to invest in with this money, and let me show you exactly what they are. I've been studying Warren Buffett for about 5 years now, and there is one theme that he consistently returns to: over the long term, equities are the best investment, and the USA is the best place to buy them. And why does he say that? First of all, it is clear why he suggests the United States. The United States is regarded as the world's most capitalistic nation. Let's just say that when it comes to business, it has made a lot of people very wealthy, and he advises purchasing stocks above other assets. As you can see, during the past 40 or so years, the most profitable investments have been US equities and US real estate. This is because over the long term, these assets, coupled with real estate, produce the highest returns. Buffett does not advocate purchasing any stock, though. One of his investing tenets is that you must purchase stocks that have a competitive edge. What he is suggesting is that you shouldn't just invest in any kind of business. Instead, look for those that are at the top of their game and have an advantage over their rivals, like Apple, who controls the largest portion of the phone and computer industries. Warren Buffett does. Another one of Buffett's assets is Coca-Cola, the most recognizable soft drink in the world. These are the kinds of stocks that we should be looking at right now, because owning the greatest companies in the world will help you feel secure and have peace of mind about your portfolio if you have $1,000 on hand. You can easily buy an Apple share to begin your portfolio, which is now trading at $151.66 per share as of the time we are doing this video. Consequently, these comprise slightly over 25% of your portfolio in percentage terms, which is comparable to the percentage Buffett has in his portfolio at Berkshire Hathaway, so that's a solid start. Then you go out and buy a few shares of, say, Coca-Cola, which is selling for $59.63 per share as of the time working on this video. Let's just suppose you buy 3 shares of Coke, which is $178.89, or 17.8% of your $1,000 portfolio. Now you have a great start on your $1,000 investment because you now own a few high-quality companies. However, you need to diversify your holdings more, and gold is one asset that I believe should be owned. Why? For instance, let's imagine a major stock market crash happens, and gold is known as a wonderful hedge for your portfolio. In that case, your stocks will undoubtedly decline. Ray Dalio believes that adding gold to one's portfolio will be both risk-reducing and return-enhancing. I'll show you the exact type of gold that Dalio and I both own. It's a gold ETF called the SPDR Gold Trust that is designed to track the price of gold. If you own gold, it's likely that it will increase in value. For this reason, Ray Dalio says that it will be both risk-reducing and return-enhancing to consider adding gold to one's portfolio. Are you enjoying this video? consider hitting the like button and subscribe. Many people's stocks declined in 2020, and we all know why. However, gold did not, as is evident by the fact that it held steady when the stock market meltdown began on February 18. Gold did not decline as much as equities did. They refer to gold as a stock market hedge because its value has increased. GLD is now trading for about $160 per share, so if you decide to purchase one, it would be $160, or 16% of your $1,000 portfolio. Generally speaking, you want to have between 5% and 10% of your portfolio in gold, at least according to Dalio. But because it is something you may develop when your income increases, let's go on and continue assembling a portfolio of high-quality assets. Okay, while this pick may seem contentious to some, it is crucial to me because of the global oil glut that we are currently facing. Does not now require much oil because everyone is remaining at home and not traveling, but businesses are still digging out oil to supply it. What does this do to the price of oil in the near term? Of course, it reduces considerably because there is no longer a need for it. This means that US investors now have the chance to buy oil when it is cheap in the short term, hold on to it until the economy picks up, and then sell it. This is a risky play because no one can predict exactly what will happen to the price of oil in the short term, but there are plenty of potential rewards to be had. Let's say that in the worst case scenario, you lose all of your investments, or in the best case scenario, you make a return of 300 or 400%. How to invest in oil? One of the better options we have is to go with the same company that Warren Buffett did, which is Occidental. Buffett said buying into Occidental was his way of betting on oil. Although it is risky, as I'm sure many people in the comments are going to point out, again, it's all about risk and reward, and I like the balance with which Occidental strikes this balance. But again, it's all about risk and reward, and I like the balance with this Occidental are selling for $16.60 per share. In other words, if you purchase 10 of these, you will own an oil-based stock worth $106. It is clear why you should have some cash in your portfolio when the portfolio is beginning to take shape. Because even if you don't have cash on hand, you will still have what you need to buy stocks when they are inexpensive in the event of a crash. As Buffett says, there is little possibility of getting a deal on anything. Cash combined with bravery in a crisis is priceless. That's why I always keep at least a portion of this portfolio in cash. We're going to put $85 in, making up 8.5% of the portfolio, and by the way, when I talk about cash, I either mean treasury bills like Warren Buffett's or cash earning interest in a bank, not cash just sitting there earning nothing. Now, investing in companies that give you a consistent, stable income every 3 months may be the greatest method to do it amid uncertain times. Consequently, a dividend aristocrat is a collection of companies for people who are unaware. The other great thing about dividend aristocrat is the data tells us that over the long term they beat the markets. They do this at less risk, and very importantly they do a lot better than most stocks and market crashes, and to top it off during those crashes. Since they have consistently increased their dividend for 25 years or more, they are essentially one of the safest forms of income stocks that money can buy. They'll still pay you, though, due to the fact that they have a history of raising dividends. It's difficult to dispute that these stocks are not the finest choices to make for novices, therefore I'm not going to. To complete this $1,000 portfolio, 2 dividend aristocrats will be added. The first investment is a stock in a firm called Hormel Foods. In uncertain times, they're a terrific firm to own because we'll still be eating things like sausage at a share price of $47. Even during a recession, beef, pig, and chicken. The last dividend aristocrat stock I would want to add to this portfolio is a stock called Target. This gives your portfolio a solid exposure to the food sector, which is a stable sector. Target is an American retailer that often sells inexpensive goods both in person and online. Again, this is a business you can rely on because, regardless of the economy we are in, people will continue to buy discounted goods. It costs $110 to complete this well-diversified portfolio, and since Target has been around since the 1970s, they have a good track record, particularly in terms of dividends. Of course, if you have $1,000 to work with, this is just the beginning of your investing journey. However, this portfolio is diversified nicely. As more money comes in, and if stocks do crash, you need to be buying more, you need to diversify the portfolio more. As long as you invest in high-quality companies and properly diversify your portfolio, you can only grow your wealth over time by buying more great businesses and paying attention to Warren Buffett's advice. Hope we were able to give you valuable input and help you get to the next step in becoming financially free. Check out the links in the description below. Thank you all for watching. Make sure to subscribe and like the video. Until then, we'll see you in the next one.